In order for you to buy real estate, many things need to come at the same time. You need to have the income, you need to have the credit, you need to have the credit score that you need to have the down payment, you need to have a deal that you found that you can find. So if you think of it, usually you may have one of those things, two of those things, but all of them at the same time, they only come at a certain points in your life. And those points are not many. It depends on every individual. So when you have a conflation or a coming together of all of those variables, that's when you should buy, because that's when you can buy, that's when you are ready to buy. It has nothing to do with the rate. It has nothing to do with what the government is doing or not doing.
Welcome, my fellow Flow Masters, to another episode of the Cash Flow Authority podcast. I'm your host, Chris Jansen, founder of the Flow Authority, and this show is for high-performing professionals who did everything right. You've got the degree, the career, and the income, but you still feel like there's just another level waiting for you. So here, we explore how real estate can become that next challenge worth building so that you can take ownership of your future and create a life by design. Now, today we're joined by an incredible guest, Mr. Alejandro Szita. Alejandro is a mortgage broker, founder of Prosperity Lending, and he specializes in financing solutions for artists, entrepreneurs, and self-employed professionals. He has experience in real estate all the way back to 2006 across residential, commercial, and capital raising roles, and is known for structuring loans for complex income profiles. He's also a regular guest on Real Estate and Finance podcasts. So welcome, Alejandro. Very excited to have you here today.
Thank you, Chris. I'm very happy to be on your show.
Awesome. So let's just jump right into it. Let's look back a little bit on your journey. How did you get started in real estate, and then the mortgage lending side of things, and kind of what led you to focus then later on self-employed borrowers? Just kind of walk us through that journey that you've been on.
It was by coincidence in a way. I did not used to be in the real estate or mortgage business. I used to be in the advertising and infomercial business. With another business partner, we created infomercials. And it so happens that one of my best infomercial clients was somebody that was beginning like a mortgage company. And he invited me, since we were friends on the infomercial side of things, he invited me and he said, Alejandro, would you like to come to a company and would you like to do a course about finances? And I said, why not? And that's basically how I began on the real estate side of things.
Gotcha. Cool. That's an interesting journey. Starting on infomercials, huh?
Yes. And we had a lot of fun. We had a lot of fun doing the infomercials because that direct response marketing is fascinating. It's a type of marketing where you get the response right away, when you know immediately if your advertising campaign is working or not working. So I did that for many years. I also sold on the Home Shopping Network a few times. I had the privilege of meeting Billy Mays, who at the time, I'm talking about in the 1990s, the early 2000s, he was like an icon on the Home Shopping Network. And then it was an interesting journey.
Yeah, I bet you picked up a ton of skills that have served you in the long run, I'm sure.
And tips from him.
Yeah. Awesome. Jumping back into the finance world, what are some of the biggest challenges that self-employed borrowers face when trying to qualify for a mortgage?
Is that lenders, to grow at scale, basically have stopped thinking. To grow at scale, and when I'm talking about scale, I'm talking about hundreds of millions, billions of dollars. Just to give you an idea, many years ago, we used to have a lot of loans that we give them to a lender called Home Point at the time. Home Point was bought by another company, but Home Point used to do about 700 or 800 loans a day. Just to give you an idea of that volume, it's almost inconceivable. In order to get to that kind of volume, you have to create rules and you have to create like a conveyor belt to do loans. So everything becomes a conveyor belt rationale. Underwriters and people that work at these institutions are like this. They are highly regulated. They have specific sort of compartments that they only look at. Now, if you contrast that to the lending of the pre-1980s, let's call it pre-1990s, lending back then was completely and utterly different. At that time, you usually had a bank that you banked with. Usually there was an individual there that knew you. Usually that individual knew what you did for a living, had a look at your bank account, had an idea of your income. And if you needed a loan, you could just sit in front of the person, explain what you need, and based on what you needed, then the loan officer at the time would say, okay, Alejandro, Chris, show me this, bring me this paper, bring me that paper, and I think we can do that. And the deal was done. That was then. But then, of course, you had to have somebody that is pretty well trained. You have to have judgment. You have to have thinking. And somewhere along the line, that got replaced by growing at scale. Now, if you have $10 million or more, and you have a private banking relationship with JP Morgan, Bank of America, Wells Fargo, all the big banks have a private banking, you still have that. You still can sit with someone, that someone would know your financial situation, and you can get a deal this way. But now it's either $10+ million or nothing. So to answer your question is, we consider that we come in the middle. Our job is to go back a little bit to the pre-1990s era, where we would listen to what you want to do. And based on what you want to do, then we would go out there and select the, I don't know how to call it, the box,
the loan product,
the box that would most likely fit your needs.
Yeah.
I don't know if that answers.
There's a ton of loan products out there, right? And so most of us don't really know.
The problem with the loan products is that they are based on the documentation. They are not based on your scenario. They are loan products that focus on tax returns, focus on bank statements, focus on profit and losses, focuses on your assets, because that's the way the lenders can grow at scale. But they don't focus on what you want to do. That's why when we do a loan, the first thing we do, we spend an hour to half an hour just listening to the client. We don't ask for anything, no papers. We don't want to see the credit report. We don't want to see any income. Just tell us what you want to do, because we are scenario-based. We're not document-based.
Mm-hmm. And so are you guys basically a private lending institution, and you have your own pool of money that you're lending out based on that situation? Or are you more brokerage and pairing people up with other institutions that then can meet their needs?
We do both. What happens is the best rate that the client will get will be using an institutional lender. So when we listen to the story, if we believe that there is a box that one of the institutional lenders has that would work for that client, we use the box to get them the better rate. If there is no box available, then we go to private money.
Okay. Makes sense. And then you mentioned credit profiles and that. So definitely, I'm newly self-employed, and looking at that, certainly credit score is one thing, but also just, I don't have employment history now. It's like the clock starts, and now I got to build up all this history of income through the self-employment. So I guess, why do many successful entrepreneurs struggle with the credit score issue despite having the strong income? And kind of what are some things they can look out for in that realm, and how can you help them there?
Because the credit score was developed to single out the most profitable borrowers to the creditors. It was not designed to measure success. It was not designed to measure how responsible you are. It was not designed to measure how financially strong you are. It was designed to capture those people that to the creditors will be the most profitable ones. And they came with these arbitrary rules. The rules that are behind the actual calculation of the FICO score are arbitrary rules made by the creditors of what they believed would be the best candidate. And then this is what happens. When you take a person that is an employee and when you take a person that is an entrepreneur, the credit decisions are completely opposite to each other. An entrepreneur maxes out his credit. Why? Because if you have let's say a $10,000 credit card and you can use the $10,000 credit card or the $10,000 to actually generate 15 or 20, you're going to do.
Yeah.
If you're an employee that you have a fixed income, you can't use the 10,000 because you don't know if you will be able to repay them or not. So you only use a fraction of it. So this is what happens. When you look at the credit report of an entrepreneur, he has multiple lines of credit. Many of them are maxed out. He might have missed one or two payments here and there because to him, he doesn't mind paying an extension fee or a penalty fee if he can get more. So those decisions are penalized by the designers of the system. However, you're an employee and you don't use your credit much, or you use it occasionally, and you use it a little, then you're getting rewarded. And this is why the self-employed or the business person has quote unquote more problems or a more quote unquote risky profile. However, and just to give you another difference, the self-employed values paid accounts. You go and you say, what about you were late here? Yeah, but I paid it off. However, the designers of the credit go, you were late. The response is you paid it off, but they don't care about that. They don't care that you paid it off. Actually, to them, the fact that you paid it off is bad because now they are not making interest income. Right. The fact that you were late stings you for 7 years. The self-employed entrepreneur said, but what are you talking about? I paid $150 late fee. It's paid off. What else you want? Now he has to suffer for 7 years because of that decision that was a good financial decision, but according to the arbitrary precepts behind the modeling of the score, that was a bad decision. And this is why you have employees that are overburdened with debt, that really don't have the capacity to pay. They have a higher score than the guy that has capacity to pay and that has higher income. Yeah. Because the system is not designed for this guy, it is designed for this guy. Now, how can we help? It so happens that there is a lot of things you can do. So we've been doing this for a while now, and now there are certain tools that the credit bureau makes available to you, to us, when we run a credit score, and we can change some variables and we can add some credit lines and pay some things here and there. And there is a specific modeling that the credit bureaus have, and you can try different alternatives, and that's how you can raise. Usually we've seen anywhere between 10 to 100 points within 1 to 3 months.
Wow, that's incredible.
We don't charge for that, by the way. This is just a free service that we do to our clients.
That's incredible. That's incredible. I do want to bring it back to real estate. So and this is just curiosity, right? I talked to a couple other lenders before, and so the traditional lenders that I'm used to seeing, they're private lenders, but they'll offer a suite of products like bridge loans, fix and flip loans, DSCR loans for long-term financing. Maybe they have commercial loans, construction loans. Do you guys offer similar products, or are you?
Yeah, we do. We consider those boxes because everyone has a specific niche. But yes, we do.
Right. Okay.
Actually, a lot of our loans are DSCR.
Oh, okay. Okay, perfect. And then how can investors use their mortgage strategically to build savings and long-term wealth? And so another way to frame this is, what should someone know before using home equity to fund business or investment opportunities?
You need to have the plan first. You need to have the property that you're going to invest, and you need to really have made your numbers, because if you take a home equity loan, whether it's a HELOC or a second or anything, or a refinance cash out, and you don't have clearly the goal, what I've seen happens is you end up spending the money, then you end up back in square zero, but now you have this gigantic debt.
Yeah. Ask me how I know that. Right. I've been there. Yeah, I've been there. I'll say I do normally spend it on real estate though. I'm not
That's
gonna
good.
lie. I do. But I still you still gotta look at the long-term repercussions of that. Hey man, what are your payments gonna be? How is this gonna affect your credit score? A couple times I used the HELOC, boom, down payment, start getting, and then this is when the first time I did that, all of a sudden my credit score was perfect, right? 800 something in the 800s, really good, right? Never missed a payment. And all of a sudden I start getting these offers, 0% balance transfer, 0%. I'm like, oh wow. I'm like, hey, I could just transfer this whole balance, pay 0%, pay a little fee up front, 0% interest, as opposed to paying it on the HELOC. And now I got the whole HELOC available. I can go do it again, right? And so I did that again. But it did take a ding on the credit score because of the utilization. And it wasn't even like overall, this is where I learned something here, is that my overall utilization was still below whatever they recommend, but 20% or whatever it was. But then those single cards were basically maxed out because I transferred the whole balance, over
Correct.
to those. So
Correct.
so just that alone, even though I had a ton of available credit, way below the utilization that they recommend, didn't matter. It still impacted it. And now it's back up to a nice spot, but then I just quit my job. So now I'm probably going to run into these self-employment issues that you're talking about.
For your case, let me say two things because this is very useful for your listeners. If you want to really understand what are the mechanics behind
Mhm.
credit score and how the framers of the scores, what are the rules that they created, you can
Mhm.
buy this on eBay. I have no affiliation with the author. It's just that this is pretty much the only one, the only course. It's 6 CDs, 6 short CDs, 40 minutes each. And this guy,
Okay.
Philip Tyrone, created this binder. He also has it on the internet without the CDs, but in my
Uh-huh.
opinion, it's not as good as buying this. It's 40 bucks on eBay, 7 Steps to 720 by Philip Tyrone.
Okay.
Do yourself a favor, get it, listen in on your car. It's very light listening. And you really understand, like I said, what do the framers of the
Yeah.
credit score really intended.
Yeah. Okay. Yeah, that's definitely helpful. I mean, there's no sense in getting upset over it. It is what it is, right? So
It
it's
is
you
what it
just
is.
gotta play the game, know the lines, know what they're looking at, and then that just goes into your decision making. Okay, I can make this wise decision over here, but that's gonna have this implication over here on the credit, and how is that gonna impact future opportunities?
Yeah,
So
yeah. And for the situation that you just told me, when
yeah,
you just quit your job, let's say you still have
uh-huh,
income, but
yeah,
because you don't have the 2 years or the 5 years
yeah,
experience, there is a type of mortgage called the community mortgage. The community mortgage, there are a few lenders that do it. It's a mortgage where it doesn't matter how long you've been at your job. All it matters is that you have the down payment, you have a reasonably good credit score, and that's it. As long as you have the down payment, you can show that you have it, and you have a reasonable score, that your employment history doesn't matter. Tax
wow,
returns don't matter.
okay,
It's the community mortgage. And this mortgage became available because the government, through the Treasury, created a special like a window. And there are a few lenders in Southern California that do this.
okay. Now, what type of down payment would that be? Would that be
20,
20%?
20, 20% usually.
Yeah, okay. Gotcha. Yeah, I'm in the process of moving to Dallas. And yeah, so I was looking at buying like a excuse me, buying like a duplex or something like that. Probably though, if I did that, I think maybe a DSCR loan would be better. I don't know.
It will be better. But on a DSCR loan, they want you to already have a house and they already want 1 year of, of a mortgage history. And if you don't have a mortgage history, like a property tax or property insurance history.
Yeah. Okay. So if you're brand new, that wouldn't work if you've never
If
done it
you're
before.
brand new, there are some DSCR products that will lend you on a DSCR basis without a mortgage history, but they are expensive. Usually, what I tell my clients is everything is in a balance. If you want less down payment, something is out of balance now, so costs are going to be higher. Interest is going to be higher.
Yeah.
Yes, you can get a 0% no money down loan, but
Yeah.
then everything else is going to be expensive because things have to be in balance. If you wanted an investment, usually all of the investment loans like DSCR
Yeah.
assume that you are already a property owner. So if you're not already a property owner, there are products out there, but in order to balance the fact that you're not a property owner, they're going to make it by increasing the costs.
Yeah. Yeah, that's a good point on the DSCR. The last time I did that, I did a refinance of the property. It's a lower cost property. This is in Wisconsin. It's a very low. It was less than 100,000 was the
Wow.
value. And so because as soon as it's less than 100, it's the amount of lenders available goes down, and then the rates go up because now there's this higher risk, perceived risk because it's less. And
it's not only that, it's because of the regulation. The regulation has certain thresholds. For example, you cannot charge, if you're a mortgage broker, you cannot charge more than a certain amount of points. If you're a lender, you cannot charge more than a certain percentage amount of costs. As the loan amounts gets lower and lower, those small costs become a bigger percentage of the loan amount, and now it triggers all of those compliance thresholds. So when it triggers that, you can still do the loan if you're a lender, but now there is more compliance that you need to put in. You need to put more forms, you need to be more watchful, because if you, let's say that one of the rules is that if you step above 5%, now you're considered to be a high cost mortgage. High cost mortgage triggers now a bunch of other regulations, and you will go 5% is a lot. It's a lot, but if you're talking about a $100,000 mortgage, that's $5,000. If the appraisal costs you $1,000, now only you have $4,000 left. There is no much money. So you have the reason under $100,000 loans are expensive is because they cost the lender a bunch of money to do the compliance, and even then they don't make any money, and that's why they're not motivated to do those loans.
Yeah. Oh, that makes total sense. Thank you for clearing that up. Yeah.
You're very welcome.
And I was going to say too, because you mentioned that the down payment, even 20 versus 25%, when I was looking at rates, was a big difference.
It's a huge difference. And then it goes every 5 and 5%. Like sometimes I get people that say, can I put 3.5% down? And I go, yes, you can. But I've never met anybody that can put 3.5% that cannot put 5%. Once you move to 5%, which is only 1.5% more, and usually in dollar amounts, it's not a lot. Now, all of a sudden, instead of having an expensive mortgage or expensive loan, you get a much cheaper conventional one. And every time you go another 5%, now you go to 10%, things change. 15%, it changes. 20%, 25%, and so on.
Nice. We like those even that's not even, it's 5. We like those increments, those solid increments. Yeah, that's funny.
By the way, you don't have to be exactly in the 5. For example, if you want to put 21% down or 21.5% down, that's totally possible. Sometimes I get clients that say, Alejandro, I don't want my payment to be more than, and they have a certain dollar amount in mind. And to hit that certain dollar amount, we have to go 23.25% down. So you're not limited to those 5% increments.
Definitely. Yeah. Makes sense. Okay. So when we're talking now about buying and then scaling with real estate, so not your first deal, you're trying to actually scale a portfolio. What should investors consider before purchasing investments or commercial properties?
You did the 10X program, which is pretty good by Grant Cardone.
Yeah.
And he covers that. But this is what I've seen in practice. Real estate, in my opinion, is one of the most creative fields that there is because you can go in many directions. But what I would recommend is real estate as it's a team player game. And then try to get partners that are willing to put the capital, but not necessarily the time. There are a lot of people that have the capital, but do not have the time, and they're not interested in participating because real estate, it does have like a passive component, but to get to the passive component, you have to work like a dog for 10 years. So usually the ads don't say that, but real estate is not passive. It's passive once you made it. But to make it, you have a few years. The ramp up, it's a few years. And I don't know, I love it, but it's very...
Even for Grant Cardone, it's not passive. And he's got a whole team, a huge team working for him. But it's still not really passive because he's always out there actively finding deals. And then, so even though he's not, once he buys it, for him, it is fairly passive because, again, he's got the whole team, but he's always looking for the next deal. So it's really not, it's a business for him. And that's how I treat it as well, as a business. And if you want to scale and really scale big, that's how you have to do it. And so in that sense, it's definitely not passive. But like you said, if you accumulate a lot of wealth, like Grant did that through his businesses first, that's one way to do this is do business, do some, whatever your business is, whatever your expertise is, and make a lot of money in that business. And then take that money and then put it as a limited partner, a passive investor into other people's deals. So that way you're hands off. You're not finding deals. You're just, here's my money, just like a mutual fund. Here's my money. It's tied up for a while, but you're just getting the returns. You're letting it build. And you got to know, I would still recommend learning a little bit so you can learn, make sure this is a good sponsor, a good general partner to be working with. This is a good property to invest in. You know how to look at the numbers and all that kind of stuff. But most business people do understand that side already. But yeah, that's definitely, unless you're doing that, unless you just, the people with a lot of money, it's like I've talked about this before, having multiple different types of currencies. Money is one currency, but then you also have your time, you have your knowledge, you have your relationships. And if you've got a ton of money, then you don't need to spend time at doing it. You just, here's my money. Go find somebody else who already has the deal and they're the one hustling. They need your money. They maybe don't have the money, but they have the time. And so you're partnering up with those right pieces to get the job done.
Yes, correct.
Yeah. Awesome. Hey, one more question before we wrap things up today.
Okay.
Given today's economic conditions, and you're not a fortune teller, I understand, but is now a good time to buy real estate, in your opinion?
I wish I could take credit for the answer, but I can't. This was given to me by a very successful realtor here in Southern California a long time ago, because we were discussing this. And I asked her, which is the best time to buy? And she responded, and I completely agree with her. In order for you to buy real estate, many things need to come at the same time. You need to have the income, you need to have the credit, you need to have the credit score that you need to have the down payment, you need to have a deal that you found that you can find. So if you think of it, usually you may have one of those things, two of those things, but all of them at the same time, they only come at a certain points in your life. And those points are not many. It depends on every individual. So when you have a conflation or a coming together of all of those variables, that's when you should buy, because that's when you can buy, that's when you are ready to buy. It has nothing to do with the rate. It has nothing to do with what the government is doing or not doing. It has to do only with when you have all of those things coming together for you.
Okay, so let me ask you this though. What if you have one of those things and then you find somebody else who has the second component, somebody else who has the third component, and then together you can partner and become a strong team? Would that allow you to buy in virtually any time, any environment?
Exactly. That is the beauty of real estate, and this is why it is a team effort, because each one of those people could have that one thing that may not be present in one person, but may be present on a team.
Yeah, absolutely. Awesome. Hey, I thank you so much, Alejandro, for your time. I keep mispronouncing your name. I don't know why I want to say Alessandro.
You can call me Alex. You can call me Alex.
Alex, there you go, Alex. Alejandro, thank you. And before we wrap, we're going to have this in the show notes, but I just want to give you opportunity as well. Where can people find you and connect with you?
You can go to my website, which is Prosperity Lending, like something prosperous, and then lending, all one word, Prosperity Lending US. And then you see my picture, you can send me an email. I have free consultations, because for most mortgage shops, the process begins with the application. Our process does not begin with the application. Our process begins way earlier, just having a brainstorming consultation. Sometimes our longest customer has been 2 years. We worked with him for 2 years before he was ready to apply and buy the home of his dreams.
Wow.
So we're not seeking an application. We're not going to be bothering you, send this and that, whatever. Just start the talk.
Yeah. People first business, it sounds like.
Yes.
Yeah.
Because we're looking to establish We're not just looking for the transaction. Yeah, the transaction pay the bills, but we're looking to establish a relationship.
Yeah. All right. Incredible. Hey, again, thank you, Alejandro, for your time. And you guys know where to find him. Check out the show notes as well for some more ways to connect with Alejandro. And yeah, appreciate the conversation. This has been fun.
Thank you, Chris. Very pleased to meet you, and thank you for inviting me to your show.
Absolutely. Thank you. Thanks for tuning in to this episode of the Cash Flow Authority podcast. We hope the insights shared today help you take the next step toward optimizing your finances and building sustainable wealth. If you enjoyed this conversation, please take a moment to subscribe on your favorite podcast platform and leave us a review. It helps other entrepreneurs and investors discover the show. And don't forget to catch the next episode for more insights. Until then, keep mastering your cash flow.